Hello, hello, hello. Can you guys hear me?
Good afternoon, good evening.
Hi, Juliet. How are you?
Yes, I can hear you.
I'm
Hi,
getting you.
wonderful, wonderful, wonderful. Uh, can you hear me?
Barely.
Really? What's wrong with your mic, Tanika? Can you hear me now, Tanika?
Yes, I can hear you.
Okay, great. Enrique, can you hear me?
Yes, I can hear you.
Okay, wonderful, wonderful. All right, so we're gonna go with what we have. Erica is in the room.
Yes, I am.
Indeed, Tanika's in the room. I saw your email, Erica.
Thank you, sir.
Jo- Juliet is here, yes. Philip. Hmm. Philip, Enrique. So Philip and Nigel are not with us yet. Does anybody in this room know Nigel?
I do.
Oh, Erica. Um, hmm. I've been trying to reach him actually.
Really?
Yeah. If you, I'm gonna try his email again, the one that I have. But if you spot him or you can reach him, ask him to touch base with me, please.
I'll tell him in the morning when I get to work.
Yeah, assuming he doesn't join us this afternoon.
Okay, if he doesn't.
All right, midterm grades, you'll probably see them sometime at a weird hour tonight, so stay tuned. Most of you won't see it until in the morning. Um, and as I mentioned last week, I don't know if you guys had any internet issues. Anybody in this class had internet issues last week?
I didn't.
No.
No? For some reason, in this part of the world, the eastern part of the world, BTC was down. Miguel's system was down, so I couldn't reach him either until some 2 hours later or some 3 hours later or something like this, when we discovered that everything had gone completely the other way, which is what prompted me to send the email for our back-to-back session so that we can finish on schedule. So if all goes well, we'll do our usual Wednesday night tonight, and then tomorrow we'll finish up. And of course, next week, Wednesday, when you do your final, it will be based only on those modules that we have covered up to where we cover come tomorrow evening. You will not be tested on the first part of the syllabus again. Only, I believe, from module 4, 4, 5, 6, and 7. Okay, so please make a note of that.
The spirit ain't telling you to cut out no chapters.
Say it again, Enrique.
The spirit ain't telling you to cut out no chapters.
It might between now and tomorrow. I'll see how it goes.
Did we even get chapter 5? I don't recall getting chapter 5.
You didn't get chapter 5? You
I don't
got,
remember seeing chapter 5.
if you got 6, 7, you should have gotten 5. Let me see. Yeah, you should have gotten chapter 5. I think chapter 5 was probably the chapter we may have just finished, if I'm not mistaken. Or finishing.
No, we're on 6. We did. I thought we just finished chapter 4.
We just finished chapter 4? Are you sure it's more? No, So I'm sorry, when I say chapter, I'm thinking in terms of modules now. I know what you mean. Let's
Okay, okay.
you probably right. Let's see if we can get on the same page. Now,
Okay,
chapter 6 happens to be module 5.
okay. Gotcha.
Module 5, and that was where we just began our discussion on the financial statements. So I think we may have, remember we were talking about working capital. Anybody remembers that simple formula for working capital? No?
So maybe you can repeat it.
Assets minus current liabilities,
Say it again?
current assets minus current liability.
Oh, darn it. Yeah, somebody actually remembered that. That's good because I will be asking you that definition and I will be asking
Apparently so.
a simple calculation in order to determine working capital. Okay, so please make it, that's a hint, by the way.
But I don't think we have, I'm looking at my notes and I see where we have chapter 4,
Hmm?
then it goes to 6, 7.
He referred to chapter 6 as chapter 5, Tanico.
Yeah, chapter 6 is actual on my schedule, module 5. Because remember, I would have emailed them to you perhaps as modules or in your case, perhaps as chapter 6 or 7. So the chapter 6 that you have is actually where we are. That's where we have our discussion of working capital and the financial statement. And so,
Oh,
yeah, so we've done chapter 5. We're now on chapter 6. And somewhere between now and tomorrow end of class, we'll seek to finish maybe 1 or 2 more chapters, one tonight, one tomorrow night. So depending on how things go, that spirit that I was talking about might
Mhm.
kick in whole or in part somewhere. Okay. So for
so,
now,
oh,
go ahead.
no, so for the final, it'll be pretty much what we have as chapter 4, chapter 6, chapter 7, and chapter 9.
Correct.
What, those 4 chapters.
Absolutely.
All of that?
Who said all of that?
That's Juliet. Juliet, you and me asking him if you don't pay attention.
I think that's a lot.
And
Well-
then the final on Monday.
No,
No, Wednesday.
say.
Oh,
Who's on Monday?
that's what I thought the email said.
That's what it
Yeah,
did say.
he typed the wrong date, but y'all have to
Yeah,
excuse
he have Monday on it.
Yeah, y'all have to excuse him. He probably was tired when he was typing though.
Absolutely. That was like 3 o'clock in the morning or something. So yeah, not Monday. That should be Wednesday. Okay. Yeah.
Okay.
All right. So I think the last time we ended up somewhere in the almost to the mid part of chapter 6, where we were talking about the working capital 6.7. And then we're about to get into our discussion about the current ratio, which is on 6.8. I think that's kind of where we left off the last time. So let's just go to page 6.8 and open up our discussion about current ratios. Now, these little accounting things, I'm not going to expect you guys to remember all the accounting mumbo jumbo. I really just want you to become acquainted with the language that credit people have to hear from time to time from an accounting perspective. Of course, credit people are not required to be accountants. Credit people are asked to do at least 1 or 2 accounting classes if you're going to be ultimately giving loans to persons who have businesses or who are self-employed. This is where this kind of information becomes very important to the credit manager and persons who work in credit. Okay? And so this is why this particular part 2 it was designed to introduce you to financial statements, to the language of accounting, to words like current and ratio, so that at least if in your profession now or later or even in some other profession, you run across these expressions, you'll not be totally in the dark. And certainly they'll mean a little something to you, if only to get you to do a little more research to see if you could recall some of this crazy stuff you did years before. All right. So the current ratio in accounting for example, remember we said that working capital represented current assets minus current liabilities. Does anybody remember some examples of current assets from last time? Some examples of current assets in the balance sheet. I don't mind if you refer to your notes. What were some of the examples of current assets that we looked at?
Accounts receivable.
Accounts receivable, thank you very much. Anyone, anything
Cash.
else? Cash.
Cash.
Cash, definitely the most liquid current asset.
And inventory.
Inventory, absolutely. So those are the typical current assets that we would find in just about any type of business, unless it's a service business. And if it's a service business, you still find cash and receivables, you just wouldn't find inventory. Okay? Inventory would exist in merchandising where we actually sell goods. So those are examples of current assets. And what about current liabilities? Anybody remember any of those?
Accounts payable.
Accounts payable. And anything else payable. Loan, payable, ASU draw payable. Anything that you owe is a liability. So when we come next Wednesday, I'm going to put some current assets and current liabilities on the paper and ask you to calculate the working capital and to explain the results. And by explaining the results, I simply mean, remember in our discussion, we said we always want to be working capital to be a positive number, 1 plus. As long as current assets are more than current liabilities, you are in good shape. If you find out that your working capital is negative, that means that your current liabilities or what you owe is greater than what you have available to cover, and that is never good. Okay? And so that's the basic example. So if somebody who owns a business comes into you for a loan, and you want to see if they have enough money, pretty much a capability to pay a loan, you calculate the working capital. If it's positive, you can say, great, this company is making enough money, they have enough receivables and inventory, whatever the current assets might be, to cover their debts, and that means that they can cover their loan payable to me as well as the lender. Okay? That's what makes the working capital part of it, the discussion, so important. If you only remember that from a financial statement for a business client or self-employed person, you're way ahead of your colleagues who have never been introduced to it before at all. They would absolutely have no way of even thinking about asking about financial statements and then specifically looking at calculating working capital. It's a very good thing to know. As a matter of fact, even in your own personal life, you can calculate your own personal working capital to see if your debts are greater than your assets, or whether your assets are greater in amount than your liabilities. A lot of people are operating in the red every month of their lives because what they have to pay out is always more than what they're earning, which is a very, very untenable position for individuals, for companies. And so any lender who is looking at negative working capital should be very concerned. But of course, you need to know about how to calculate it. And this is why we spend some time doing that. Another measurement for lenders is called the current ratio. It's a very simple formula. Anybody read that far? The calculation of current ratio? Right on the top of page 6.8. Says current ratio is obtained by doing what? Very top of 6.8. Nobody sees it, line 3.
By dividing total current assets by total current debts.
Yes. So in working capital, we subtract current liabilities from current assets. But for the calculation of current ratio, we actually divide current assets by current debts. And we'll see in a moment why we do this. This is pretty much to give the lender some indication of how strong the cash and asset position is for the company. And if you look at the calculation in the very next paragraph, you will see that we have several versions of the calculation of current ratio. But at the end of the day, the idea is to have a current ratio position, pretty much something like working capital, a current ratio position where you have a positive ratio as opposed to a negative ratio. All right. I think it might be better if we get somebody to read it out to us so that those who may not have had a chance to read can actually focus and hopefully retain some of this stuff as the information is put forth. Let me see. Who was the brave person who volunteered last time? I don't want to call that person just yet again. Tanika, did you read the last time?
Yes, I did.
You did. Okay. Oh yeah, you did. For a while, I believe.
I can read a few pages, just
Who
a few.
said that?
Juliet.
Yeah. Why just a few, Juliet? See, that sounds like a trick question. Okay, Juliet, let it rip. Read a few pages, and when you felt if you've had enough, said, okay, somebody else's turn. How's that? Okay?
I didn't hear you. I didn't hear your phone. It went out.
Oh, can you hear me now? Can you
I
hear
can
me?
hear you.
Can you hear me now, Juliet?
Your phone is breaking up. Yes, I can hear you.
Okay. Everybody else can hear me?
I can hear you. I think it may be Juliet's area.
Yes, I can.
Yeah, I
It's
can hear
fine.
you.
Yeah,
Probably
Juliet,
Juliet area for true.
yeah, Juliet, how's it? I think it might be your connection. Can you hear me now?
Yeah, I can hear you now.
Okay, great. Yeah, it seems like it for a minute it was coming in and out. So here's what I was saying, Julia. Go ahead and read as many pages as you would like to read, and then when you're done, you say, "Okay, that's it for me," and then you nominate the person who will read next. So you guys are going to run yourselves a little bit this evening. So go ahead, Juliet. When you have had enough, say, "Okay, I've had enough," and then you will nominate one of your colleagues and say, call a name, and then they'll jump in. All right?
Okay.
All right, let's go. Let it rip.
Relationship. All the current first presentation of the XYZ company. There were total current assets of 1,000 and total current liabilities 50. Current is 2, meaning that there are $2 of current dollar of currency. This is normally expressed as a 2.1 current ratio. In the other example, $1,000 and current debts of $150,000. In this current is .1 ratio 1. Current ratio then is of the amount of assets to the amount of currencies. And a last financially sophisticated, a current ratio of 2 or better automatically considered to be a sign of financial strength. The more protected creditors, the standards of the and even or make asset analysis.
So, Juliet, before you go on, let me just make a note here. For those of you, if you notice, let me ask you a question before she goes on. The ratio of 2 to 1 versus the ratio of 1.33 to 1. Which one do you think is the better ratio? Anyone? Which one do you think is the better ratio? Anyone? Make a guess.
2 to 1.
Yeah, 2 to 1. Why did you pick that one? You're right. And what? I'm just wondering, why did you pick that one?
Because you have 2 to 1. I don't know, like when something just so simple, you kind of don't know how to explain it.
I know, of course, but you're right. And if this was a multiple choice question, even though you couldn't explain it entirely, you'd still get the answer correct. That's why you should always give things a shot, because you never know. Okay, so the larger the ratio, the better the ratio. Same as working capital. So in this example, the ratio is 2 to 1. In other words, you have twice as much in assets as you have in liabilities, as opposed to the second one where you only have 1 1/3 in assets as opposed to liabilities. So the better ratio would be the one with a higher asset value, which is in this case the first one. Now, in other words, you have more assets in 1 to cover your liabilities than you have in 2, which is only 1.33. Notice in the first example, the assets total 100,000 divided by 50,000 in liabilities. In the second example, the assets increased, and so you might say, well, the assets increased. Why is it that the ratio is not better? Who can guess why the ratio is not better in the second example? Because the debts have also increased by how much? In the second example, the debts increased by how much? What were the total debts in the first example? Anyone? What were the total debts or liabilities in the first example? Make a guess, anyone, let it rip. The total liabilities in the first example was how much?
Was it
Go ahead, was it?
oh, the total, you say current liabilities?
Total current liabilities in the first example was how much?
50,000?
Yes. And the total current liabilities in the second example was how much?
Um,
Total current liabilities or total current debts was how much in the second example?
The current debt in the second, 150,000.
$150,000. And so the total liabilities or debts increased by how much? From 50 to 150, that's an increase of how much dollars?
100,000.
$100,000. And so even though the assets increased by to $200,000, the ratio ended up being lower because the debts also increased by $100,000. In other words, for you guys who are doing loans and who are managing your own financial affairs, one of the problems that Bahamians and people around the world have is this. They get increases in salary and they're still trying to figure out why they don't have any extra money. Has anybody figured it out from this example yet?
Because when they get an increase, they still go max it out.
By increasing their debt. Thank you
Right.
very much. All right. So if you don't remember this stuff for your loans and your clients, remember it for yourself. If you get an increase in assets or money, and you go ahead and increase your debts to credit cards or loans or other borrowing, then you will find yourself in the same predicament as before or worse. It's an important lesson for all of us who are trying to manage money. Okay? Lots of Bahamians earn pretty decent salaries, but they can't see much of it at the end of each month because their debts are significant. And as long as you owe money, you will have very little bit of money to save, because theoretically, when you get your money, you have to pay your debts first. And if you have too many debts, you're not going to have too much money left at the end of each month, if any at all. Very common problem for individuals, very common problem even for small and medium-sized businesses. And so working capital and current ratio are important numbers to know for the lender. Okay? So please be well aware of that in case you run into that stuff somewhere in your lending future. Okay, keep going, Juliet. The quick ratio.
The quick ratio, the composition of the current assets has a great bearing on the liquidity. In the current ratio, all current assets are regarded in the same light as having the same degree of liquidity. Now we know better than that. Naturally, firms' bank balances is the most liquid asset, followed closely by government and readily marketable securities, if the firm has any, and by trade receivables. These are the liquid assets. Cash in those assets readily converted into cash without sales effort. The other current asset is inventory. This is often the largest current asset. However, it is also the current asset that is the furthest away from turning into cash and the most difficult current to assign a dollar value to. It requires more time and attention for conversion into cash. For the manufacturing concern, at least some of the inventory needs processing. And for all the mercantile enterprises, all of their inventories require the expenditure of sales efforts before being turned into receivables and cash. A more refined measure of liquidity then is called the quick ratio. This is calculated by dividing the liquid assets, current assets minus inventory, by current debts. In our first presentation of the XYZ company, total liquid assets were $75,000, consisting of $25,000 cash and $50,000 accounts receivable, while the current debts were $50,000. The quick ratio here is a handsome 1.5 by 1. In the other example of the XYZ company.
Sorry, Juliet. That little
Right.
quote a little colon in between.
Mhm.
That's how we say that expression, 1.5 to 1. Okay?
1.5 to 1. Okay,
Yeah. Even in other matters, wherever you see a ratio like that, that's how we say it. Okay?
okay.
Go ahead.
In the other example of the XYZ company, the quick ratio is 0.66, 2 by 3 by 1. Since cash and receivables total $100,000 and current debts $150,000, the quick ratio is also called the liquid ratio or the asset test. Regardless of the name, it can be a very comforting one to credit managers if it is anything point, what you said, one?
Say it again, if it is 1 to
What did you say? It's one,
1
one
to
to one, okay, 1 to
What,
1
but
with $1. What you said, Enrique? Anyhow,
go
1
ahead.
to 1 with $1 of liquid assets to meet each dollar of current debts. Of course, this can be reduced by absurdity, the most liquid condition of all. Absolute liquidity exists when current assets consist completely of cash and current liabilities are at zero. But the normal mercantile selling, manufacturing, or distributing merchandise every day. It will also always have a variety of current assets and an assortment of current liabilities. So a quick ratio of 1 to 1 is not a sign of perfection, nor is a quick ratio of 1 to 5 a sign of disaster. The individual items making up the liquid and current assets have to be subjected to examination. No one ratio is overwhelming significant all by itself. Naturally, credit people are delighted with balance sheets which show strong cash positions. Of the three principal circulating assets, cash is probably the one which fluctuates most. As large receivables are collected and as big debts are paid, as the most liquid of the assets, its health and condition are self-evident and require no analytical techniques. The cash balances shown on a balance sheet should be accurate since it can be easily checked with the depository. The quality condition of the other two principal current assets, receivables and the inventory, are not so readily ascertainable. Each of these assets is subject to losses and to shrinkage in value. Their condition can be of paramount importance since they represent the bulk of current assets and therefore the principal means available for payment of debts. If the current ratio and the quick ratio are to have any real significance in a credit decision, inventory and the receivables should be analyzed to get a closer determination of their financial health.
Okay, before you go on, Juliet, let me say this while it's fresh in our minds. Backing up a little bit to the current versus quick ratio, notice the only difference between the two is that when we're calculating quick ratio, we're taking out the inventory from the current assets so we can see how liquid the company that we're evaluating as a credit officer really is. Does anybody know what liquidity means? If a company is liquid that comes to borrow money from you, what does that mean?
They have plenty cash?
Yeah, thank you very much. Couldn't put it better myself. They have a significant amount of cash on the balance sheet, which means that even if you don't understand everything on the balance sheet, because you're not an accountant, you're a lender, even though lenders should understand a little bit about financial statements, which is why I'm dragging you through the mud a little bit with some of this language and conversation. When you pick up a balance sheet for a potential customer or even an existing customer who is self-employed, for example, if you only have the wherewithal to say, where's the cash balance? And you look at the cash balance and you see, $130,000. That alone gives you a sense of comfort that the organization is generating sufficient cash to cover its position potentially. And certainly it looks like they have the ability to pay a loan because they have a healthy cash position. Of course, the real value of that 130,000 will not be tested until you check the other side of the balance sheet and look for, anybody knows?
But I have a question.
Yes.
If a business has that much cash, well, it depends. How big of a loan are we talking about? Like 50,000 or something?
Well, I'm glad you mentioned that because everything is relative, yes? So a company might have $130,000, but the question might be, how much are they looking to borrow? And based on what they're looking to borrow, the 130,000 may still not help them. Or depending on what they're looking to borrow, the 130,000 will look very good to the lender, like, man, this guy can pay $1,000 a month pretty comfortably for this loan. Okay, so again, it all depends on the amount that they are seeking to borrow at the time. Okay, and that really is one of the key challenges you would have remembered from the credit manager's decision, that the first question that the credit manager should always, or credit person should always be asking is, how much do you wish to borrow? That's the starting point. The second step is, how long do you want to borrow it for? And then the third step might be, here's the rate of interest at which we can lend you this money. Okay? Those three steps in the lending process are absolutely crucial. And in order to come up with a decision that is good for your firm in terms of whether you should do a loan, yes, you're looking at the balance sheet of a self-employed, you're looking at the cash position, but you have to be clear on those three questions. And then once you establish those three questions, you can look at the company's balance sheet and say, in your opinion, do they have enough working capital to make these loan payments? Do they have enough cash on the account to make these loan payments potentially? Because I mean, if you pick up a balance sheet and you see $33.17, I don't know about you, but that would make me very uncomfortable. Okay, $500 would make me uncomfortable. $3,000 would make me uncomfortable, unless it's a mom and pop shop. So you see, everything about what's good and acceptable for the credit officer manager is a function of the situation. How much they want to borrow, what is the debt going to be? Do they have enough assets to cover their commitments so that your loan does not run into trouble potentially? So these are very key things that lenders would want to be, especially that working capital calculation, and meaning that current ratio calculation where you want your assets to be at least greater than 1 or more than your liabilities. And then certainly the quick ratio is also very important because it lets the lender know how liquid the company really is. Because some companies, they may have current assets of $300,000 and 270,000 might be what? Inventory. So that doesn't make them very liquid because inventory has to wait until somebody comes to buy them. Okay. So in that example, you really only have liquidity of $30,000. And so lenders need to be aware of these things so that they can understand what kind of entity they're dealing with and whether or not the request that they're making for a loan is reasonable or not. Is it always a simple decision? Hell no. Lending is sometimes far more complex depending on the type of lending we're doing. In this case, we're talking about commercial business lending. And that's quite different, as you probably see already, from lending for a home or lending for a car or lending for a piece of property. But they do have similarities in the sense that the lender must still, if the person is self-employed, look at their balance sheet, look at their bank statement, and based on the kinds of things we were discussing in terms of working capital and ratios, current and liquid, whether or not this company potentially has the money to pay back your debt. That's really the real reason why you understand these things. All right. Keep going, Juliet.
Okay. Analyzing accounts receivables. To make any appraisal of a firm's accounts receivable, the now about the general payment habits in the customer's industry. Is the customer in an industry where collections from customers run smoothly, or do collections require much time and effort? Then I, of course, should have a knowledge of customers' normal selling terms. The best measure of the condition of accounts receivable is called an aging of receivables. This is a schedule of the accounts receivables outstanding at statement date, broken down by month of shipment. For instance, the XYZ company had total receivable 31st, 1999, $50,000 would classify into subtotals for each month of shipment as follows. November $20,000, November $15,000, October $10,000, September $3,000, prior months comes to $50,000. Knowing that the XYZ company sells its customers on 60 days, we can reasonably assume that $15,000 of that firm's total receivables are past due. The bulk of this amount, $10,000, is no more than 30 days past due. However, usually is not serious. There is $3,000 now, 31 to 60 days past due, 1,000 60 days past due. In most industries, these proportions would be acceptable. The analysis would feel better about these receivables if the XYZ company had provided vision for of 2,500 or so. A valuation reserved to reduce $50,000 total, the more realistically $40. It is a reflection of good business judgment of the concern's management of its balance sheet, shows such a reserve for possible losses in accounts receivables. Quite often, an aging of receivable is not made available with a financial statement. Still, there are tasks that be applied. Computation of the turnover of receivable collection period. By dividing the annual net sales by accounts receivable, we calculate the number of receivables turned over into cash during the year. For example, let us go back again to the XYZ company and its receivable over 50,000 at December 31st, 1999. If the concern had sales of for the year, then its receivable turnover was 5 times a year. Continuing our example for easy math, it is always assumed that a year has 360 days. Dividing 360 days by 5, 72 days, which is the period in our illustration. Since XYZ company sells on 60-day terms, taking an average of 12 days beyond maturity for the concern to collect its bills. In most quarters, the average period essentially ratio. It expresses the relationship accounts receivable, the latter's quality.
Okay, before then, Juliet goes into inventory, again, this discussion about receivable, we move from the current ratios and the quick ratios and the working capital, which are more liquid assets, into the inventory, which is not so liquid, because inventory, unless you're a food store or Starbucks or something that's moving quickly, your inventory tends to move considerably slower in terms of being converted to cash than cash itself, obviously, and accounts receivable where you can run people down and threaten to call, take them to court if they don't pay. Receivables, so The receivables on the other hand, unlike inventory, requires a little time to get people to pay. You have to wait a little bit. The average person will come in to pay. Some people will come in late, and a couple of people will not come in at all. And so collecting on accounts receivable could be tricky, which means that it's important to account for it properly so you know how much is owing to the company. A lot of people are in business and they do not know what their accounts receivable total really is. They either have no number at all, or they have some number that they're not sure about. Okay? And so, of course, if you start getting things messed up with your receivables, then you may miss calling customers who owe you money. And so typically, in many instances, money could literally be going down the drain because you don't have a proper receivable system in place to let you know who owes you money and how much. And so if you have somebody coming to borrow money from you, you may want to sit with that self-employed person and talk to them about their receivables, now that you know a little bit about receivables, if they in fact have any receivables at all. Okay? But these are things that are important to note so that you can determine if the company is making a great effort to collect its outstanding balances. Just remember, if you do not collect your receivables on a regular basis, it is going to affect your cash flow. It's really just as simple as that. And that's why a lot of businesses are in trouble today, because they sell a bunch of stuff on credit to family, friends, people in the church, and all that kind of stuff on credit. The Sister Juliet, I know I can depend on you to give me these $300 worth of dresses, and I'll pay you when I get paid. And so Sister Juliet is so kind-hearted. She says, okay, the only problem is what Sister Juliet may not remember or even be aware of is that when you give somebody credit, you don't have any cash. They get to keep their money, but you don't have any cash. And you are now having to wait until they decide to come in. Hopefully they will come in as promised, but that doesn't always happen. Okay? So it's important to account for receivables, whether you use the aging method or just a logbook or a spreadsheet or whatever the case might be, so that you always have an idea, albeit an exact idea, of who owes you money and how much. Okay? Very important when people come in to pay on their accounts, make sure that the money actually goes to the account, is actually posted to the account, and the correct balance is brought down. These are all critical, serious matters for credit people to consider, and even business people, many of whom do not consider. And that's why oftentimes they end up in trouble. So they have strong credit ability because they want to be smiling with all the customers and giving credit. But on the other hand, when payments start coming in slowly or not at all, then they don't have the ability or interest in trying to collect it. And if they have a loan, ultimately this negligence on the part of the business person, if they're not keen, will also affect your loan. So it's very important that you look at that number and that you talk to the business person about receivables, especially the balancing inordinately high. Find out what efforts are being made to collect the money. Why are you still giving credit with all this money outstanding? Church people, I don't want God to charge me. And the truth is, he won't charge you if you're trying to make a good business decision. Okay, he really won't. All right. Okay, Juliet, keep going.
Analyzing inventory. We can apply the same sort of measurements to inventory and obtain an idea of its health and vitality by year and information of the number of times a concern moves or sells its inventory. Actually, the higher inventory, the period of a concern holds its inventory before, say, the healthier inventory A meaningful measurement of can be obtained. Information is the dollar amount of inventory added to inventory provides an inventory figure, which is a more accurate divisor. Further, the sales figure profit, the cost of sold for the period is a more accurate inventory used. Thus, a more turnover rate can be obtained by dividing the cost of a really comprehensive inventory involves more than computation of rates. A balance sheet by and the concerned sales volume is uncertain still be made regarding inventory. We have already discussed the liquid ratio of inventory working to capital. You can in this relationship directly by inventory by working capital and get percentage figure. Larger the percent inventory is in comparison to as another thought, the inventory might hello?
Who said hello?
Can you hear me?
Is that you, Juliet?
Yes.
Yeah, we can hear you.
Zoom cut out just a while ago. Yours cut out.
Yeah, it did cut out a little bit, but we can hear you.
Okay, I'll continue.
Yeah.
Okay, I'll continue then.
Okay.
An aging of inventory is seldom given in financial statements. Unfortunately, many concerns never prepare this analysis of their inventory for their own use. Even though this is information that a business enterprise should have to aid it, occasionally situations and inventory aging is information credit analysis should try to obtain needed when slow payments are evident and the bulk of the credit protection current assets is represented by inventory and the latter shows a low down of inventory among raw materials, work and finished goods. A preponderance of finished goods in the inventory of a operating in a highly industry might be a danger sign on a balance at season. The inventory which appears on a concern's balance sheet is the merchandise unsold at statement date. Its components vary widely in nature. Some of it might be raw materials just received by the customer. Some might be all goods many months old. As accurate as possible, the inventory statement date, the closing inventory should, and its components price of cost or replacement. This requires a lot of hard work and a lot of good business judgment. Many firms do not value in this way, but simply use estimates. This finance, though it nonetheless be an honest estimate condition. If a financial statement shows it and value at the lower of the cost of the market, we then have some assurance the inventory figure
There you are.
The point was made previously that honest errors as well as deliberate misrepresentation can occur in the process of inventory valuation. Analysis, experience and judgment, the knowledge of the responsibility and character of the concerns accountant is the credit person's aging the value.
Okay,
Okay, I'm done. My phone keeps cutting out, so let someone else read.
perfect. You did an amazing job under those conditions. Okay, that's fantastic. I'm just going to say a couple of things about inventory, and then you will choose who will pick up the baton from you, Juliet. So think about it while I make a few important points. So far, we've talked about all kinds of different types of current assets and how to calculate the working capital, the current ratio, the quick ratio, and all that stuff. And so this last discussion really was about inventory, which is the least liquid of all of the current assets. And this little discussion, you would have noticed, I hope, talked about the importance of making sure that when you pick up a balance sheet and look at the inventory figure, you as the lender need to try and decide, is that figure a correct figure? The text says very clearly that it's not always easy to make that determination. Some companies have an inventory method that the valuation that they use in accounting to help them come up with a proper value for inventory. Other companies use what we call the lower of cost or market, where they look at the cost price for the inventory that they have in stock, and then they look at the market price, and whichever is lower, they do the multiplication and they come up with a total for inventory value. On the other hand, that's a mathematical approach. On the other hand, we have companies who actually just guesstimate. They don't even take inventory. They don't take stock. They don't count the inventory and multiply by the cost of the goods to come up with a fairly accurate inventory figure at the end of the month or year. They just say, well, it looks like I have approximately $100,000 in inventory based on no counting, no mathematical calculation, none of that stuff, just a pure guesstimate. That is a danger for the owner as well as the lender. And so lenders need to be very careful when they pick up a balance sheet. They look at the inventory number to try to determine if that number is reasonable. Some lenders, depending on how much money that they're being asked to lend, they don't take the owner of the business word. They said, I want to go down and see the inventory. And depending on what the banker sees, they might decide, I need you to take inventory and satisfy me. Because if we're going to be holding this inventory as collateral, we want to be in a position to determine as near as possible the actual value of the inventory. So inventory is always a bone of contention, not only for the owners of businesses who are fighting to convert goods from manufacturing goods to final products to sell, and even retail people who buy stuff to sell, waiting for people to come in to purchase those things off the shelf. In the meantime, while we're waiting for buyers to come in, we need to know what those inventory values are. We need to know what's left after the purchases have been done at the end of the month or year. And if you are a lender, you are very interested in these kinds of numbers if your client has a significant amount of inventory. In fact, where the inventory forms the base of the income for that particular firm, you as the lender must satisfy yourself as much as possible that the valuation being declared for inventory is at least reasonable, if not accurate. Okay. In that last paragraph, she touched on one or two important things for lenders, where she said that the credit analysts that you guys must use their own experience and judgment. Included in judgment is something called common sense. Included in experience is something called, you've seen so many different kinds of loans, characters, liars, and others in trying to get you to give them a loan. That experience and that judgment is required at all times. And in this case, with regards to lending money to somebody who's self-employed or owns a business. Okay? The knowledge of the credit person, the knowledge and experience of the owner of the business. Are they responsible? Do they have the proper ability to run that business? What kind of character do they have? Who is the management person or persons? Are they capable? Is there an accountant? Or is somebody trying to think that they're an accountant? The credit person must look at all these things, because these things will present the best guidelines for that person who's looking to lend the money of their organization to some company. Of course, we have billions of dollars in company loans, but lenders don't just give them the money. Well, some of them do, depending on the situation. That's their buddy, they get bribed, and all of the evil, wicked stuff. But under normal conditions, lenders want to consider those key things as far as possible about the person that they're planning to lend money to. Are they of good character? Do they have an accountant for their business to help them keep the numbers as accurate as possible and to give an independent perspective? And as opposed to trying to do it yourself when you're not qualified, nor are you going to tell the truth about everything because you act trying to be an accountant, and whatever you need to fix, you're going to fix to try and make it look better and all this crazy stuff. Okay? So these attributes are very important to the credit person. And when somebody comes in with their balance sheet, eventually, if not initially, the more experience you have in dealing with these kinds of clients, the more you understand the language of this stuff, which the hope is that you're not going to be accountants when you're done, but you sure as hell not going to be shocked by certain expressions when you're done. And that's the whole idea. All right.
Mr. Wilkinson, I have a question.
Yes.
Is it wise for a credit officer to visit a business client office to do a proper assessment?
Absolutely. As a matter of fact, and it's interesting you should raise that, because surprisingly, there are still credit people who do not see the wisdom in doing that. Now, if the business person is coming in for a little $10,000 overdraft, you might say, $10,000, not a whole lot of money, and maybe not conduct a visit unless something spooks you. But any significant amount of money that you're looking to lend, it is always a good idea to go and look at the operation, because sometimes business owners lie through their teeth about what they have on premises, how many vehicles they have, what condition they're in, that they actually own the premises when in fact they're renting it, all kinds of crazy things. In fact, in some cases, you might even discover that they don't have a premise at all. All right, so yes, when it's time to give out the bank's money, the lender's money, it is always, always, always a good idea to conduct a physical search if the amount that you're looking to lend is significant. And sometimes not so significant, just to make sure that the person is on the up and up, and that whatever decision you take is based on something real, not the absence of stuff and a bunch of lying and exaggerating about things like inventory, assets, equipment, and vehicles, or whatever else. Not to mention making sure, in addition to the visit, making sure that whatever liabilities are declared, that you check them to see if they actually exist. And to see whether or not the balances, estimated balances that are given to you by the business owner are actually somewhere near the truth. Okay. So this commercial business types loans to self-employed people, you can see straight away, unlike the traditional buying credit union kind of loans, they were still lending. But our clientele is shifting. The language that we have to be aware of for certain types of merchandising and other clients need to be a little bit different from what we've been used to. And this is the whole idea, to give you a completely balanced perspective of the world of credit. Because believe it or not, there are a lot of people out there who are not even aware of the extent of the amount of merchandising credit that takes place around the world. Because we are so stuck and accustomed to the traditional kinds of credit. Even though merchandising credit is not new, it's just that it doesn't get the kind of recognition and discussion as do other types of credits. Understandably so, it's not fancy, but it is hugely important. All right, Juliet, have you picked your candidate for the baton?
Chantel?
Chantel, are you there?
Yes, I am.
You have been called out by your colleague, Juliet, who did a nice job with that crazy internet that she has coming and going. But she didn't give up. She didn't say, to hell with this bloody internet, I'm not reading anymore. She didn't say, I have the perfect excuse. It's my internet. Can't you guys hear it? And she would have been right. But she didn't do that. She doggone came in and went out. Went out and came in until the end. All right, way to go, Juliet. All right, Chantel, are you there?
But where did she left off? I'm so sorry because my book came apart.
What does came apart mean?
No, I had it in spirals.
Uh-huh.
The notes in spirals. The notes.
Oh,
I had it in spirals, and it came apart. Which page you left off, Juliet?
yeah.
I was on 6.13.
Okay,
I think number,
Yeah, measuring success.
Okay. A business enterprise is formed to make money. The fact that a particular product or products are manufactured, wholesaled, or retailed is only a means to that end profit. Profits are the final measure of concern success. The more profits earned, the greater the success. And usually the more profitable a business, the better credit risk it is. It is a company is making money steadily. Creditors are willing to overlook some balance sheet weaknesses, feeling that profits will ultimately increase working capital and correct the minor weaknesses. Further, creditors also feel that management of a profitable concern will do everything it can to keep the business going, while management of an unprofitable concern might be more inclined to give up the ship. There are three ways of measuring the profit shown by an income statement. One, of course, is the dollar amount of the profit itself. The larger it is, the more impressive it is. To really impress the credit manager, however, the greater part of these profits should be retained in the business as increases in equity and working capital. If most of the profits are withdrawn or paid out in dividends, there is no tangible increase in the protection available to creditors. There are two ratios by which profits can be measured in relation to the size and scope of concern. A measure of the success of sales effort of an enterprise is the rate of profit generated by each dollar of business transacted. We find this ratio expressed as percentage by dividing the annual net profit by the annual sales. Going back to the XYZ company, we stated that its volume from 19 was 250,000. If its net profit that year was 10,000, the net profit on sales was 4%.
Yeah, oh, that's interesting, isn't it?
Yeah.
Yeah. So I start thinking, oh, interesting. Is that a good return or not? Well, and I'm glad you said, because see, if, for example, banks were still paying great interest rates like they used to for a long, long time ago, like 8%, 9%, 10%. Believe it or not, rates were that good a lifetime ago. Then you can say that, hey, if I can get 10% on my fixed deposit, I don't need to go into a business where I'm only earning what? In this example, how much, what return are you earning in this example?
We've-
You said it.
Was 4%.
Yeah, 4%.
4% on my net return. I mean, I don't know.
Yeah. Like that's not great, depending on.
No,
Yeah, you got it. So in some businesses, people might celebrate, say, yay, it's a profit, and they're right. But uh, if you actually start looking at it relatively speaking, let's say if you could earn 6% or 8% on a CD, then you might as well not go through the stress of opening a business. Just put your money
correct.
on a CD. Okay. And again, this is just you thinking about yourself, maybe one day in the future. When it comes to you as the lender, and you're looking at your client, and you're looking at this kind of return, you might actually say to your client, given the nature of your business, what are your other competitors doing? Are they also earning 3, 4, 5%? If everybody's in the category, then you say, hey, fine, we could live with that. But if you're earning a return of 5%, sorry, 4%, and your competitors are earning 7, 9, 12%, then the lender is going to be concerned about that. And that's one of the things the lender is going to look at as well. What is your return versus your competitors? Okay? And if your return is significantly low compared to your competitors, that lender is probably going to panic and say, you know what? Don't call us.
They call you.
You call. All right. Keep going. And
If this percentage seems low when compared with the results of previous years or with figures or other firms in the trade, the answer might be found by computing the other measurements, net profit on equity. We find this rate of return on investment by dividing the annual net profit by equity. If the XYZ company has a net worth of 100,000 and a net profit of 10,000, would represent a 10% return on its capital. This is an unacceptable percentage. If the net profit of sales seem low, it may be the result of competitive conditions. Possibly. The concern may be achieving its sales volume at the expense of markup gross per sales per dollar, but it is nevertheless coming up with net profits that are respectable when compared to the capital investment. This is a very common situation in American business.
and in Bahamian business, even though
Yeah.
people are not even aware. We just sell stuff, yuck stuff at the cash register and go to Disney or something. But yes, very common here too. Okay, keep going.
This ratio of net profit on equity has a significance of its own. It is logical to maintain that more profits produced per each dollar of capital invested by the owners, the more successfully is the company fulfilling its reason for existence. Twelve. Mr. Wilkerson, move on.
Absolutely.
Okay, using ratios. An analyst can create other ratios by comparing. I have a question.
Yes.
When it comes to the income statement of a business, right? Should the credit officer look at three solid, what is the minimum amount of years? Should it be 5 years, 3 years?
Ideally, it should be 5 years. That's not etched in stone.
Okay.
If you say 5 years and for some reason your potential borrower says, well, I don't have 5 years of statement because I've only been in business for 3 years, then 3 years would be fine. Absolutely. Okay. But typically for a company that's been around for more than 5 years, and again, 5 years will depend on how much money you're looking to lend. If you're looking to lend a significant amount of your company's money, then you want to go back to at least 5 years to see what the sales were, the profitability, the stability, the movement of inventory, whatever it is you're looking at, those things we talked about over 5 years. If the amount you're lending is not like an ungodly amount of money, or the client has only been in business for 2 or 3 years, then you can we'll go with the 3-year statements to do our evaluation. Okay, that's an absolutely critical question that you just asked. And believe it or not, a lot of lenders even who are doing commercial loans and doing loans for small businesses and people of companies oftentimes do not see the wisdom depending on the loan request and the circumstances actually getting, say, that amount of financials. Because usually they let the business owner talk them out of it. I don't have it, it's gonna take too long, it's gonna cost me money and all this kind of stuff. Maybe. And again, it's not hard and fast. If the amount to be loaned is significant, you may want to go as far back as 5. If it is not so significant, or you have experience with this client already, or some such thing as makes you relatively comfortable, 3 years would be sufficiently for most cases. Okay, great question. Keep going.
Using ratios, an analyst can create other ratios by comparing one dollar amount on a financial statement with another. Credit management should use any of the analytical tools to prove helpful in making credit decisions. The ratios we have described in detail are the most frequently used and are generally considered to be the most important in credit. Credit analysts, they provide the newcomer to the credit profession with the basic equipment needed to learn something from financial statements about a customer ability to pay bills. There are many other ratios listed in various texts. Ratios have been used to show the rate of net profit on working capital, to express the relationship on current debts to inventory, of inventory to current assets, or accounts receivable to inventory or working capital, to equity of current debts to equity of total debts to equity of fixed assets to equity, and to express the turnover rate of working capital. To
No.
tie together.
Sorry, I don't want you guys to presume I'm gonna try and ask you to unravel all that crazy ratio stuff. That bit of information is there for those who understand much more about accounting and ratios to put it in perspective. But certainly for you guys, that is just an introductory paragraph to show you how many ways ratio analysis can be used to make business and loan assessments. So far, we have touched and talked about the really key ones in terms of working capital and current and quick and inventory turnover and all this kind of stuff. Those are really the hardcore ones that you really want to remember. All these other examples are just to show you the many different ways that this analysis can be done, depending on the situation within a particular loan environment. Okay? All right.
Mr. Wilkinson, what about the how does I try to remember some stuff. EBITDA, earnings before interest, taxes, amortization, something like that. Or
Yeah, and really, again, that, that particular calculation and determination would be something, a lender would be interested in. If, for example, they are looking at maybe a big ticket, proposal, or maybe they're looking at a term that's normally longer than their 3 to 5 to 7 year period.
Okay.
For some, and so, yeah, they would look at, the earnings figure or the profit figure, before taxes, and then what the profitability looks like after taxes, and how taxes would impact the cash flow of the company in terms of net profits after earnings and taxes. That's what that baby's all about. And
Okay.
so, yeah, again, it goes back to a more sophisticated assessment of profits, and what cash flow would look like before taxes are taken out for the government, and what, cash flow would look like after taxes are taken out for government, in terms of what's available to pay debt and to meet other commitments of the firm, by all means.
Okay.
Go ahead.
To tie together the material so far presented in this chapter, a few comments should be made regarding the turnover rate of working capital. This ratio is calculated by dividing annual sales by working capital. The larger the resultant number is, the more volatile the credit risk. Mr. Wilkerson, what that mean, resulted? What that mean? More risk? What?
Oh, resultant?
Yeah. Okay,
that-
yeah.
That really just comes from the word result.
Okay.
The larger the number that is the result of the sales that you calculated for the year, then the credit risk would be. Yes. Okay, so resultant is just an extension of the word result, meaning the results of. Okay. So for example, if I add 2 plus 3, the result would be what?
5.
Absolutely. And the resultant number would be 5. That's all that is.
So, we're being more volatile, meaning more fluctuated or risky, because
Yeah.
I have larger sales numbers.
Absolutely. Okay. And of course, volatile means ever changing and unpredictable.
Yes.
And so, whenever we look, at we're saying as numbers, as the resulting or resultant number gets larger and larger, then it's harder and harder to determine the level of credit risk that you'll be dealing with, because you're now dealing with bigger and bigger numbers, and then as numbers get bigger, the results become more unpredictable.
Okay.
Absolutely.
The turnover of working capital is a ratio whose chief usefulness is that it highlights the strengths or weakness revealed by the current ratio and the liquid ratio. The working capital turnover rate, when high, depicts a large volume in relation to a modest working capital. This is the sort of situation which results in large inventories and large or heavy current debts. While expanding sales are very desirable, increasing volume inevitably brings with it expanded current liabilities.
In other words, yes, you want to sell, but oftentimes when we want to sell, we end up getting a larger overdraft facility to buy more inventory, or going to the bank to borrow money to buy more inventory because we want to sell more, sell. And if we're not careful, even though we might be selling, we're also increasing our what? Debt, our liabilities. Yes. Okay. And so lenders and owners of companies alike have to always be careful that while you're increasing returns or sales, or even your income from 3 or 4 jobs that you're working, if you are continuing to increase your debts and borrow more and more from different institutions, then you will find that you might end up zeroing out at the end of the day. Because at some Yeah, if you don't be careful, you will have to be paying out more in loan payments and debt payments than you're actually generating from those 3 or 4 jobs that you're working.
Right, and then you could have an inventory sitting there for months and not moving.
And that's the spooky part. When you are buying inventory, before you go out and put yourself into debt by increasing your stock, make sure somehow as a business owner and a lender that that company is increasing debt or spending money to buy inventory that will what? Move.
Right.
Okay? A lot of companies make the mistake of getting inventory and piling it up somewhere that is not moving or moving very slow. That is a very dangerous position to be, okay? By all means. And even if you're a lender, you have to be looking at that inventory position and asking your customer, how often does your inventory turn over? And what do we mean by turnover? How often do you sell out and have to replace them? And if you say twice a year, is that good or bad? For the most part.
The bad thing, depending on business you're in.
Yeah, for most retail businesses, turnover twice a year is bad. That means that you're only selling all the inventory twice a year. That's not enough. That may not be enough to make you as profitable as you want to be, and that may not even be enough to help you pay your bills, including your loan payments, which is why a lot of companies are oftentimes in trouble because they don't understand it, and some of them who have an idea, they don't listen or adhere to it until something goes very wrong. Okay? So this whole thing about this inventory side of current assets, absolutely crucial. Just that one asset alone can make or break a company if it's not managed properly and can send lenders into a tailspin if the owners of the company do not take the appropriate steps to make sure they're only buying the appropriate inventory, they're buying inventory that is going to turn over, and that they're monitoring inventory all the time to see what's moving and what's not. Okay? Absolutely. All right, keep going. Chantel? Are you there, Chantel? Are you muted?
The turnover of working capital is a ratio whose chief usefulness is that it highlights the strengths or weaknesses revealed by the current ratio and the liquid ratio. The working capital turnover, when high, depicts a large volume in relation to a modest working capital. This is the sort of situation which results in large inventories, large or heavy current debts, while expanding sales are very desirable. Increasing volume inevitably brings with it expanded current liabilities. I think we went through that. 13, overtrading. The larger current liabilities are in relation to working capital. The less protection they have, this situation in combination with a high working capital turnover and the unfavorable current ratio and liquid ratio that results are symptoms of a credit problem called overtrading. Okay.
And of course, for the average business person and the lender, if you see the word overtrading, it should make you wonder, like, overtrading, is that good or bad? Can somebody Google overtrading? Let's see if it's in Google. Let's see if Google has that word. Put Google to the test. Doggone it, they're supposed to know everything. Type in trading. Let's see what Google has to say, if anything. Over trading. What is it in Google?
Mr. Wilkinson, and my thinking, I'm thinking that, if you do a lot of over trading, that means you're not, you're using your working capital, right? Because your capital is supposed to be something that you use to hedge. It's like a hedge protection for your business, correct? Something like a hedge, right?
Right. So if you're over trading or overselling, it means you're buying oftentimes too much inventory, or borrowing to get too much inventory by getting loans to buy in too much inventory because somebody told you that that was going to sell quickly. You believe them, and so you go out, get a loan, buy a whole bunch of stuff, and then you discover that it's not moving. So you have this.
But you could deplete your capital.
Oh yeah, you have
But you
this,
could deplete your capital.
your working capital. Take it from
Yes.
positive to negative by all means. The only
Yeah.
way that over trading is successful if those products are turning over rapidly.
Deplete.
Yes.
Okay.
Okay. If they're just average products that turn over at Christmas time, at Easter time, at Junkanoo time, or whatever, you have to be careful. You don't get stuck with too much of it. Okay. Even the food stores, they monitor on a regular basis what products are selling and which products are not moving quickly. Which is why sometimes you might go to the food store and see one product, and then a couple of weeks later you don't see it anymore. Sometimes they change supplier, or they simply move it because it's not selling fast enough. And they replace it, in their opinion, by another product that they believe will sell faster. Okay? And that's kind of the whole deal of moving inventory. Inventory is a very important asset for merchandising businesses of any kind, manufacturing business of any kind. But if you are in the business of selling merchandise inventory of any kind, you have to be watching and monitoring on a regular basis to make sure that that inventory is moving as fast as you need it to move so that your cash flow position does not suffer. Some companies do this quite well, others don't do it so well, and others really suck at trying to manage inventory. Because managing inventory requires a certain amount of skill and commitment. And even people who have businesses, they oftentimes don't want to spend the time to acquire the skill or make the commitment. And therefore, their companies oftentimes suffer. Suffer even unto death. And somebody tell me what the death of a company, how does a company die? How do you know when a company is dead? In one word, give me one word. How do you know a company is dead? One word.
Insolvent, like,
Say it again.
insolvent, bankruptcy,
Okay, bankruptcy is one word. Yep.
insolvent. I know this is insolvent. That might be incorrect. Insolvent.
No, insolvent is.
What is it?
Say it again.
Well, I said bankruptcy,
Bank-
insolvent. That might
Insolvent.
be incorrect.
What about that simple word called closed? Like when you drive past one day, it's closed. You're like, what the hell happened to that? It was there for the last year. I even stopped once or twice. Maybe that's why, because you only stop once or twice. Maybe some other customers only stop once or twice. And therefore, once or twice from a handful of people turned out to be insufficient turnover for that company or business to survive. Okay, quite as simple as that, unfortunately. All right. So, which is one of the reasons why the first thing potential entrepreneurs are told if they bother to ask anyone, because sometimes people don't like to ask. They like to do whatever they feel like because they haven't even started yet and they think they have all the answers to all the questions. Okay. But one of the key things to ask yourself before you're going into any business is whatever product I'm selling, what is the likelihood that it would sell? Can I create enough demand for enough people to come in after expenses for this to work? Some people do it successfully, others do it not so successfully. Not that they didn't do a great try, but sometimes no matter how well you plan, certain things just don't work. Okay? It's like, for example, when they forced Prince Charles to marry Princess Diana. Anybody remember that? Anybody remembers that? No? Okay. Does anybody know when the coronation is going to be?
Supposed to be, yes, Saturday or Sunday.
Yeah, on Saturday, Bahamas time.
Mhm.
For those of you who want to be up at 5 o'clock to watch it from the beginning, be my guest. I don't have time to watch royalty that's wasting people's money, having fun and doing nothing. For centuries, while other people suffer, they have to go to work every day. I don't know why they don't see the ridiculousness in that yet. But anyway, that is just one of the many flaws that we have as humankind, I suppose. Okay? People are sleeping in the street, need equipment for school, dying from hunger and all that stuff, and they're there with the taxpayers' money, having a ball every day, doing no work, waving and smiling, getting into trouble, doing nonsense. Let me not go there. I don't know if that's a credit or collection problem. All right, keep going, Chantel.
When a concern is overtrading, it is able to liquidate its current debts as they mature only by continuing to generate a high business. Any sudden change for the worse in any of the many factors which influence. Unfortunately, its creditors are therefore vulnerable too. The danger is under control so long as the concerned operations are profitable and a short-term credit continues readily available. Oversimplified and over trader is an adequate credit risk, so as long as it can continue to overtrade. The ability to grant credit successfully to overtraders probably represents the highest level of job performance in the credit profession. Most credit grantors cannot afford to pass up the business offered by overtraders. By their very nature, firms that overtrade are big users of goods, and they constitute an important segment of the business transacted in most industries. Further, it is often from its class of risk that tomorrow's commercial giants emerge. The credit manager will spend much time working on the accounts of overtrading customer concerns. These marginal accounts require close and constant supervision. Frequent investigations must be made on these accounts to determine if they will be able to sustain profitable operations and if an ample supply of short-term credit and financing continues to be available. In supervising overtraders and all customer accounts, the credit analyst will use either formally or informally the ratios we have described. The purpose of ratios is to express as concisely as possible those relationships among financial statement items that have credit significance. The strict numerical values of the ratios are not nearly so important as the proportions of the relationship expressed. Ratios are the shorthand of the financial statement analyst. By learning the concept of ratios, the newcomer to credit is learning how to come to grasp with the use of financial statements in the making of credit decisions.
All right, thank you so much, Chantel, for bringing all that crazy alive. Made me even interested again in all that crazy ratio, over trading, increased liability, profitability, madness, return on profit and investment. But these are words and language that every lender of some kind, of every kind, need to have some familiarity with. And that is why I kind of drag you guys through the mud a little bit with it, because somewhere along the way, it will be helpful in your jobs. If you change jobs in your personal life, if you're even advising your customers who come in for a mortgage loan for a house, see? Or when they came in for the mortgage 5 years ago, they may not have been self-employed. 5 years later, they might decide to take the package from a telco or some other place and then open up a business, and suddenly you have somebody who's no longer an employee when they came for the loan, but they're now a business owner. And so now you guys would not panic. Say, oh, you're a business owner. Great. I just finished this bloody course in credit collections. Come right in this room. I have some questions for you. First of all, where are your financial statements? And I said, Miss, how do you know about that? I only hear about my house loan. Says, I know, but I know you're self-employed. I need to see your financial statements to see if you have the ability, Mr. Jones, to continue making these loan payments. Then he'll be like, what a sec. She knows about financial statement. Then he's gonna finally admit it. I am not miss. And then all of a sudden now you have a whole other issue. Then because you did this thing, he said, well, Mr. Jones, since you're no longer an employee, you need to go and get some financial statements done on your business. I need them for 3 years. I only been in business 2 years, Chantel. And then you say, well, go and have them prepared for 2 years so that I can evaluate them. I can look at a few important ratios to see whether or not your business is doing well enough for you to continue to pay this loan properly. So all of a sudden, and then you go and dust down your notes, open your electronic file, say, where are those notes I did in that class? Let me look at some stuff to see what I did. And all of a sudden, the thing comes alive from a client who was not even a business owner when they got the mortgage. So I dare say there's no such thing as, what the heck does all these ratios have to do with me? And all I do are house loans. Well, I hope that I have enlightened you a little bit on why it's important, even though you may only be doing, as you say, house loans or what we call mortgage loans. Okay. All right, great stuff, Chantel. You have to call out the next person, Chantel, who will take the baton from you.
P. Russell.
Who?
P. Russell.
P. Russell, are you there? P. Russell has been called out to take the baton.
Okay, then Enrique Russell.
Okay, the other Russell. Enrique. Enrique?
I was sleeping, you know. Anyway.
Well, you know what? Then it's a good thing the other Russell didn't. Where's the other Russell anyway? The only reason I know, the only reason why we're calling Enrique is because the other Russell did not answer. And so, yeah, Enrique, you have been called up to the mound. You've been asked to take the baton by Chantel.
Making comparisons. Ratios are an ideal means of making comparisons, and comparisons are another means of analyzing financial statements. The credit manager will compare the customer's most recent financial statement with earlier ones. The tool for this type of analysis is the comparative financial statement form, a spreadsheet which should be kept in each customer's credit file.
Oh yeah, that file. There we go.
On the spreadsheet or comparative form, the credit analyst, enters summaries of concerns financial statements as the statements are obtained. All asset and liability items are entered under the appropriate labels, as are the sales and profit or loss figures from the income statements. It is always best to compare a company's successive annual statements drawn up as of the same date each year. Such statements prepared in the same season each year are directly comparable. Analysis by comparison can be most enlightening and can strengthen, modify, and sometimes even change the opinion that an analysis
I know, it's a
might form from. Pardon?
tongue twister.
Yeah,
Yeah, that and analyst. It's a
yeah.
tongue. Mhm. Keep going.
Might form from studying only the latest financial statement. For instance, the most recent statement of a company might show a reasonably good financial condition. When set up alongside the two preceding annual statements of the concern, you might see that working capital has been reduced materially over the last 2 years by losses or large increases in fixed assets. Before granting credit in such a case, the credit manager should learn the reasons for this detrimental trend and assure that it has been reversed. The key word in the preceding paragraph is trend. Comparative statement analysis helps the analyst determine the direction in which a business is moving. This comparative study shows if the concern is going forward by operating profitably and by increasing equity and working capital. It also shows us if the business enterprise is not progressing, if the firm is losing money, or if its working capital is dwindling. In analyzing a customer concern, credit management is interested in the trend of working capital, equity, sales, earnings, inventory, and other important financial statement items, and the trend of the various statement relationships expressed by ratios. For example, is the current ratio improving and has the turnover rate of inventory increased? Trends are almost as important to the analyst
Yeah, analyst.
as the financial condition of a company at its most recent statement date. A concern whose trends are favorable, making steady progress and strengthening its financial condition is a more attractive credit risk than the company that shows an equally satisfactory financial condition, but a condition which nonetheless has been steadily deteriorating. A sample comparative statement form with figures or 3 years spread thereon is illustrating on the following pages.
Okay, thank you very much, Enrique. For the moment, you get away this evening because your little expose is now followed by an actual comparative financial statement. So I'm not gonna ask you to try and go through this stuff. I'll take a moment until we're done, and then when we get back to the narrative at the end, you can kick in for the final blah blah blah. So
Okay.
let's take a look. Let's take a look at this comparative financial statement. If you look at it on the left-hand side, we have a description of some things we talked about: cash, securities, receivables, inventory, which gives us our total current assets. And then we have our liabilities. But before we have our liabilities, we have some other assets, plant assets like equipment, computers, and whatever other fixed assets the company might have, land, or whatever the case might be. All of those kinds of things would be under fixed assets. And then after that, we show our payables or liabilities, and then our equity numbers. So let's just take a moment. Again, I'm not expecting you guys to be able to mess with all of the details of the financial statement. I just want you to be able to get a generic look at how the financial statement actually looks and what are some of the key points that we already discussed, how they look on the financial statement. So the first financial statement that we're going to look at on a comparative basis is the balance sheet. How many years does this balance sheet cover based on what you see? At the very top on the statement date, how many years would you say this balance sheet covers?
2 years.
How many?
2 years.
2 or 3?
Or you saying 2 and then the one would say 1 year. I guess 3.
Yeah, altogether, the way.
Yeah, altogether 3.
Now, in practice, you wouldn't see 2 years ago, 1 year ago current. In practice, in the real world, you'll see 2020, 2021, 2022. And then you know automatically it's a 3-year comparative, okay?
Mm.
They just kind of write it in there for persons like students and others who may not actually be familiar with the setup of a balance sheet. So these are 3-year statements. So we go back to the 3rd year back, working our way forward. What is the cash balance that we have 3 years ago?
$70,171.
Yeah, 1 year ago,
$72,913.
and currently,
$87,486.
is our current position good or bad compared to the previous?
Good. It
Good.
increased.
Position.
Yeah, they increased, even though in the 3rd year was 78 and 72, then it went up to 87. So basically, the lender knows from just looking at that comparative statement for cash, the cash position is what? Fairly stable. Okay. What about marketable securities? These are treasury bills, for example, that you can turn into cash pretty much at a moment's notice. In this example, this current asset called marketable securities existed for the last 2 years, but in the current year, it's not there. What do you think they did?
They probably sold them.
Yeah, they probably sold it. And if
Yeah.
they sold it for some of the money may have gone into the cash to make that 87 up. Other parts of the money may have gone into some purchases of inventory or other equipment, etc. Okay, this is how it works pretty much in business. And then our accounts receivable, are they increasing or decreasing?
Increasing.
Yeah, which is good or bad?
Yeah.
If they're increasing but you're collecting money regularly, that increase is good. If it's increasing and you're not collecting money regularly, becoming stagnant, then that number is bad. Okay, and your liquidity is a direct function of how quickly you can collect the money that is outstanding. Okay? Any other assets current?
Inventory.
Inventory. Now notice, we talked about overtrading, didn't we?
Yes, the $138,000. Wow.
Yeah, I sure as hell hope they have a plan to get rid of that quickly. All right, because if they don't, and of course, you as lenders, now you have an idea of how to be looking at things, and at least at minimum, raise a question. Mr. Jones, hold it. 2 years ago, you were down to 58,000. Now you are more than twice that amount in the current year. What's with all the inventory? Why did you get all of the inventory? Are you sure it's going to sell? Do you even have this much inventory on hand? Because sometimes people put numbers that don't exist. They lie. Did you know that?
Yeah,
I-
they speak numbers.
Yeah, they're just putting stuff to make the balance sheet look better.
Mhm.
And so sometimes lenders have to follow their judgment from 58 to 138. I'm not saying you're lying, but I'd like to go and see this inventory. And sometimes you might go there, and when you get to the warehouse, only a few boxes and a few corners, nowhere near 138,000. Okay, just the fact of life. Or you go there and potentially it is 138,000 roughly. But then once you determine that, you need to find out what's the plan to get rid of it. Because if you don't get rid of it quick enough, you're not gonna have the money to pay my loan or any other bills. That's the point. All right, so the total current assets for this entity, Bristol Candy, is for 2 years ago is how much?
$210,975.
Yes, and then increasing year over year to a current asset position of
$294,570.
good news potentially or not?
Good news.
Good news. If something happens with that bloody 138,000,
Yeah.
if you take those numbers and I were to say to you, calculate the working capital for Candy Company. Well, you know the working capital is cash,
Mhm.
marketable securities, accounts receivable, and inventory. If you use those numbers, and then you go down further, which we see later, and subtract your debt, that will give you one position. If you take inventory out in the current year, it will change your ratio position significantly. Okay, and so it is very important that you see these numbers, that you're satisfied within reason with the numbers, and that so that when you apply your ratio analysis, your current ratio, your quick ratio, your inventory turnover, whatever ratios you're looking at, you're fairly comfortable that you're getting numbers that can help you make a good loan decision. Okay, which is why the character of your borrower is so important as well. Because if you, especially if you've done loans with the borrower before, or they come, you get a good message that they are honest and reliable people, then you can rely even on the financial information they give you, because you will extend that integrity to the information that is provided. Either way, though, it's not a hard and fast rule, and it's not a science. People do stuff, people make mistakes, and people do things deliberately. We just have to work our way through it to see if we can come up with the best possible credit decision. So current assets total increasing year over year. Then we have our what we call our fixed assets, which are the equipment. Any other fixed assets?
Other investments.
Other long-term investments and other receivables. Now, fixed assets are those assets that will generally continue year over year in the business. They are not usually consumed within the financial year, which is 1 year. Like current assets, they turn over quickly all through the year. Fixed assets are not like that. They carry over from year to year to year. So the total fixed assets for this company, can we determine that?
Yes.
Do they have the number there?
Yes.
What's the number for total fixed assets for the current year?
$561,237.
Who agrees with Enrique? Total fixed assets. Everybody agrees with Enrique?
No,
Who said no?
I said Chantel,
Why do you disagree, Chantal?
because in that total you have investment other, And then you have miscellaneous receivables. But then you didn't, and then you also have, also in that arena, plant, property, equipment, that's a fixed asset, which is $253,000 plus dollars.
So what is the actual total fixed assets then?
561,000. No, that's again.
Total fixed assets? Well, let's have a look.
53, I could be wrong.
How much?
Use that one. $253,755.
That's the total for plant and equipment. But to that, we have to add the other fixed asset, which is investments of 6,496. And
Mr. Wilkinson, we can't hear you no more.
Oh, Lord, listen.
PTC done it again, must say for him.
They getting like BPL?
no, I'm here. I'm here.
Okay, sir.
If you add those three, what do you get? This is it again.
561.
Uh-uh,
No?
uh-uh. If you add two,
Hold
three,
on. Sorry. I'm looking at the wrong thing.
I know.
Okay.
Only add the fixed assets.
Okay, that's inventory. Accounts receivable. 294570.
Absolutely. And then when that's the total fixed assets, and
Yes,
then
sir.
when we add the total current assets, what do we get?
You get to 561.
Absolutely. So how you see the total assets are made up of total current assets plus total fixed assets. Okay, 561. Now, let's look at the current liabilities, current period. And I jumped to current now because we kind of the mini experts. We know what's happening in that previous stuff in this comparative thing. So we can carry over whenever we want. So let's look at the current liabilities, current period. Due to the banks, you owe money, how much?
25,000.
5,000. Accounts payable, you owe different people other than the bank. How much is that?
$10,654.
Yes, and then your next liability is to the government. How much is that?
$79,131.
Taxes, VAT, or whatever the tax is, corporate tax, VAT tax, whatever the tax is, it's 79,000. Any other current liabilities?
Accrued wages,
How much?
$8,635.
Anybody knows what accrued wages are? Ever heard it? No?
That's
Accrued-
salary expenses.
It is. It's salary that persons have already earned, but you haven't paid it yet. You're gonna pay it next payday. Okay? People have already worked, but you haven't paid because you will pay in the next pay period. That's what an accrued expense is. That's why it's a liability, because you owe it to the staff or whoever works. Okay? So what are your total current liabilities?
$123,420.
Absolutely. Any long-term liability?
Yes,
Yeah, the first one is how much?
125,000.
Yeah, followed by
Common stock,
common stock, which is the ownership in the business of how much?
$150,000.
Notice the stock figure doesn't change year over year unless somebody buys more stock, the company, or sells some stock. Other than that, it remains the same year over year. Anything else in the liability equity category?
Retained earnings,
Retained earnings of how much?
$162,817.
Excellent. Now, if I were to say to you, what is the total current liabilities plus long-term liabilities plus equity? Now, let me just say this about equity. Equity is made up of two categories, common stock and retained earnings. So if I ask you what the sum of your total current liabilities plus long-term liabilities plus equity, what would be that total?
Chantel, you calculating?
Chantal? Are you calculating?
She had a calculator earlier, so
Chantal, you're the one calculating? I guess you figured out by now you need a calculator next Wednesday. Chantal,
Yes, sir?
Enrique wanted to know if you were adding stuff up. Current liabilities, long-term liabilities plus equity.
let me calculate.
Or somebody else can kick in.
He must be sleeping.
It's been a long day to be talking about all this crazy mumbo jumbo. Nobody added it up? Total current liabilities, total long-term plus equity? What did you get, Chantel? Any takers? Nobody has a calculator, phone, computer? Well, according to your notes, if you add them up, what should you get?
$561,237.
Absolutely. And so you can see that the balance sheet will then be in balance when your total assets are equal to your total liabilities and equity. Okay, that's what we mean by a balance sheet is in balance. If you pick up a balance sheet and those two numbers do not agree, something is wrong with that balance sheet. Tell your client, take it back to the accountant and fix it, because the total assets must always be equal to the sum of liabilities plus equity. Always. Always. All right, in fact, you may want to write that down. Assets are equal to liabilities plus equity. What constitutes equity? Common stock and retained earnings. Nice little stuff to know. You never know.
Say that again. Assets are equal to
Liabilities plus equity. If you pick up a balance sheet and that equation does not work, then something is wrong with that balance sheet. Okay, and you will now be in a position to tell your customer that you're aware that something is wrong and they need to take it back to the accountant and fix it. Okay. All right. So that's your balance sheet. So let's take a moment then and look at the other financial statement that you're likely to see, and it's called the profit and loss statement. Again, we're going to look at the current period because we are now familiar with the comparative aspect of things. Now, if you notice, this income statement or this profit and loss statement has a lot of steps going on before we get to net profit to see whether or not the company made a profit or a loss. So let's take a few moments and quickly look at the components of this profit and loss statement. It opens up with sales of how much current? Total sales of how much?
$1,106,155.
Absolutely. And then subtracted from that sales figure is the cost of goods sold of 719,000. Now, cost of goods sold is simply what you had to pay to buy the inventory.
Mhm.
So before you can come up with net profit, you have to subtract what you had to pay to buy the inventory because you need that money to buy inventory again.
Question, so does also include operating expenses too?
No,
Possible. No?
later.
Okay.
Yeah,
Okay.
good question. A lot of people try to mix it up. And therefore they come up with an income statement that is not good. So the first thing you subtract from sales is your cost of sales because you need that 719,000 to go back and buy more goods. Otherwise, you're out of business. Okay. And so when we subtract cost of goods sold, we end up with a gross profit of how much?
$387,157.
Exactly, but that's only gross because you have not yet removed what she just asked, expenses.
Right.
Salaries, light, water, phone, every other expense you can think about, NIB, SOB, QRT, whatever expenses you have to pay, they fall into the expense category, which total what?
$143,432.
Absolutely. And let's not forget the other expense that doesn't involve money. It's called depreciation of that equipment that you have.
Right.
In this example, the depreciation is equal to
$5,122.
absolutely. So now that we've accounted for all of our costs and expenses, we can then say that the net income for this company is what?
$238,603.
My. So now, even though the sales were fabulous, 1.1 million, it doesn't end there. You have to take out all of your expenses first. And then you see what your net sales position is of 238,000. And for those of you who want to calculate the return on your sales to see if you should have opened up a CD or continued this business, you know what the formula is. Now, you take the total sales net and divide it by net income. And that will give you your percentage return for that year. Okay. Nice figure to know. All right. So based on this information alone, you should be able to calculate net income. So come next Wednesday, if I give you these numbers or any other numbers and say, prepare a balance sheet, a simple balance sheet and an income statement, you guys should not have too much trouble doing that. But is this income statement finished?
No.
No. Another amount has to come out before you have a final net position. What is that?
Federal income taxes.
Yeah, in the Bahamas government taxes, not income.
Wow.
Yeah, VAT. Okay. 114,000 looks like almost half of the net income before taxes, correct?
Yeah,
Yeah, and somebody asked about EBT, blah, blah, blah. This is earnings before interest and taxes now. Because earnings before interest and taxes was 238,603. Then we have the tax amount of 114,528. And after that, we end up with a final net income of how much?
$124,075.
Yes, one stinky 124,000. I mean, that's still uh, a pretty okay number for net profit. But when you think that your sales were what? 1.1 billion,
Mhm.
you now see why it's so important to manage your costs and manage your affairs and move your inventory as quickly as you can, because if you're not doing all those things effectively and simultaneously, you are going to have a problem. Okay? By all means. All right. So now you see what a balance sheet looks like in the real world and an income statement looks like in the real world. And based on these very basic numbers, you should be able to do some assessments and ratios and be able to establish a balance sheet and an income statement, okay, for next week, Wednesday. Hint, hint, hint. Okay? All right. I won't drag you through the net worth part of things. That's for another time and place. I think you have more than enough to keep you busy with the ratios that we've discussed and the balance sheet and income statement items for you to familiarize yourself with in order to be able to do a simple assessment and prepare a simple set of statements. So that when your people bust into Dodge City next time with their business proposal or their self-employment financial statements, you will not be taken aback. Or even if a colleague is stuck, you can kick in and say, you should have done that bloody class. I'll help you for a fee or something, for lunch. All right, so we're now down to the final four paragraphs, 5 paragraphs. Enrique, you can finish us up. It is often instructive.
It is often instructive to see how a firm measures up against its peers, how its statements compare with the statements of other concerns in the same trade. Many questions can be asked in this context to gauge the performance of a particular enterprise. Is company A's inventory turnover lower or higher than that of similar concerns? And is its current ratio better or worse? How does its net profit on sales and on equity compare to results achieved by other companies? As credit managers become familiar with a particular trade or industry, they develop a set of standards regarding proportions and ratios of financial statements of companies in that field. They learn from experience what is normal and average for the industry in terms of both condition and performance. They also learn what is above average and what is subnormal. For a skilled credit manager, these standards may exist only in the mind as an attitude and frame of reference. But even though they have never been put down on paper, these are definite standards representing years of accumulated experience. These standards are accurate and concise guideposts of quality in the evaluation of credit risks. New members of the credit profession can speed their acquisition of their own standards by accumulating the necessary data and formalizing it. They can compute their own industry norms. One way of doing this is to collect from their own credit files the recent financial statements of all customers in a particular trade. An average balance sheet and income statement can be then prepared, and average measurements and ratios can be calculated. Each industry has peculiar problems and characteristics which will be reflected by the statements of concerns operating in that trade. A ratio that is normal or acceptable in one line of business can be unacceptable in another. It should be remembered that each of the ratios, measurements, and trades Available for study are only the individual parts of a full analysis of a financial statement. It is the composite picture that counts in the final analysis.
Yes, indeed. So, in essence, after all that fighting with chapter 6 and that very important discussion on financial information, financial statement, financial ratios, these form the core of the decision-making process, which we'll be looking at a little bit when we come back next week in chapter 7. Uh, um, because depending on the type of client that you have, if they have a business, this information becomes absolutely vital. And in some cases, even if their employees, certain aspects of the information can actually be help us to determine, for example, debt service ratios and certain other calculations in terms of salary versus expenses, etc., to help make decisions even from an individual employee level. So one way or the other, all of this information comes together, all of our knowledge about the industries that we're in, whether it's merchandising, mortgages, consumer loans, whatever type of loans, business loans of whatever type, whatever area we find ourselves as credit professionals, we have to take the knowledge and skills and experience and standards that we've learned and apply it to that particular industry to which we are employed. In case many of you guys who work for mortgage corporation, for example, you're talking about the mortgage loan industry. For you guys who work for credit unions, you're talking about sundry types of loans to your membership, property loans, car loans, other consumer loans, vacation loans, all kinds of stuff. And so depending on the industry you're in, you can find out the necessary information, financial or otherwise, create these standards, and over time, you get better and better, as you already know through experience. And when your experience gets better, your judgment improves, and then you can look at client applications much more critically, much more effectively, and then help you to be able to make better credit decisions. All right. So when we come back next week, tomorrow, we will look at some of the elements that go into making the credit decision for a little bit, and then we'll look at a few collection techniques from a non-traditional perspective. One or two areas that you may not necessarily have been involved in because the type of loan or lending industry that you're in. So you get not only another perspective, but a more balanced perspective on what goes on in the credit and collections world, which is always better than lopsided. All right, so when we come back next week, we pick up with chapter 7, and then we finish up with
I say next week.
sorry, tomorrow, still thinking next week, thank you, Enrique. And then we'll finish up with some important concepts in chapter 8, and then you guys will be good to go and get ready for your final exam. Luckily, we have a weekend in between, and hopefully you can use that to your advantage. Any questions before we break? All right, fantastic. Don't go away. I shall see you guys in a few hours tomorrow, same time.
Good evening or good night, rather.
Good
Night.
Good
evening.
night.
Good night. Good night. Okay, bye.